Hey everybody, welcome back to another edition of 5 Question Friday. And yes, I know it's actually Saturday, but better late than never. I've got 5 great questions that you guys have sent in that we're going to cover today. If you want to submit a question, the best way to do it, subscribe to the newsletter. It's free, it goes out every Sunday morning. You can see the link below this video. And just shoot me an email with the question you have, and that's how you get a question on the show. So let's dive right in. Here are the 5 questions we're going to look at today. Number 1, is now a good time to change your asset allocation? Number 2, do target date funds force you to sell stocks in a down market? Number 3, does the IRS treat the withdrawal of dividends from a Roth IRA as taking out the earnings or the contributions? We'll look at that. Is an 80% chance of success in retirement reasonable? And we'll talk more specifically about using that as a way to think about your withdrawal strategy. And then finally, how much should you allocate to international stocks? Typo. There we go. All right, so that's what we're going to cover today. So let's dive right in. Here was the first question. I'm a young investor, still decades away from retirement, and I've been fully invested in all equities for years, but only in the U.S. market. I'm now convinced it's time to diversify into some international equities as well. When is the right time to make that shift? That's the basic question. And here, I think about changes in asset allocation in 2 different ways. First, there are situations where your life circumstances change, and it dictates a change in how you're investing. So a good example of that might be that you plan to retire, say, 5 years from now, but because of health or family or your job situation, you're forced to retire early, you're forced to retire now. Or I guess the reverse could happen. You plan to retire now, and then, good or bad, you're going to work another 5 years. So when you have those sort of unexpected changes in our lives, it can sometimes dictate a change in the asset allocation, and I think that makes sense. And I would tend to just make that change when those events transpired, right? And now what this viewer is asking is a little different. For some reason, they don't explain why, but for some reason, while they were comfortable just in U.S. stocks until now, 2025, they want to move into international stocks. So here's my concern about that kind of change in an asset allocation, and I've confronted this issue in different contexts many times, and it's this: I don't trust myself. And I think, okay, am I wanting to make this change because I truly think it's the best change, whether it results in lower returns for some period of time, perhaps, or am I actually just chasing performance? It just so happens that this year, international stocks are up and U.S. stocks are down, not by a lot right at the moment, but they were down by more, but they've come up a bit. But still, international stocks, if you measure it by, say, an index fund that covers pretty much the market except for U.S., it outperforms a U.S.-only portfolio this year by roughly about 15% at this point. My concern would be, I'm making this change because I'm chasing that performance. Gold is up. So if you don't have any exposure to gold and you're thinking, now might be a good time to invest in gold, I would have the same question. Is it because you're chasing performance? Now, at the end of the day, only you can answer that question. But when I'm thinking about changes in my asset allocation, I prefer to make them, in this case, if I were going to say, increase my allocation to international stocks, I would prefer to make that when international stocks were kind of flat or at least not much different than U.S. stocks, or even preferably, maybe they were lower, maybe they were going down as compared to, say, U.S. stocks. I'd be comfortable moving, some allocation changes then as well. Not as a point, the point not being to time the market or even to sort of tactically change my asset allocation. To me, it would still be a permanent change. It's just that under those circumstances, I don't have to worry about the problem of, am I really just chasing performance? And that's what's really happening. I'm just trying to make it sound better by, coming up with this reason for all of a sudden wanting international stocks. All of which goes to a bigger question, and that is, if you make this change, can you stick with it no matter what happens in the markets? Again, only you can answer that question, but that's the concern I have if I'm changing asset allocation in a way that's putting more money into something that's gone up a lot, recently, in this case, like international stocks. That doesn't mean it's a bad move. It doesn't mean that you shouldn't make that move, but I do think you should consider that before making any changes. In terms of how you actually go about it, I mean, I would just make the change, whatever it is. Some might be uncomfortable making such a big move all at once. You could certainly decide, okay, I'm going to move a little bit once a month or once a quarter over the next year, sort of dollar cost average into the change. I think that's perfectly reasonable. Probably wouldn't be how I would do it, but I think both ways, again, are reasonable. So that's question one. Good question. Number two, do target date funds force you to sell stocks in a down market? Here was the question. This viewer, she said she's in retirement. She's got, let's say, a target date retirement fund, or maybe even better, sort of a life strategy fund from Vanguard type of fund that doesn't change the asset allocation. But imagine it's a 50-50 stock and bond portfolio. She says, so I cannot sell bonds from those accounts to use for living expenses during downturns without also selling stocks. And the point being, since it's a fund that invests in both stocks and bonds, when you sell shares, you're going to sell effectively both stocks and bonds. And so the question is here, should I avoid the mutual funds that combine stocks and bonds, such as target date funds? Or again, I mentioned life strategy funds. Another example would be Vanguard Wellesley, that type of fund. So here's the ultimate question is this. Do you want your asset allocation to change in retirement? If the answer is no, then a fund that invests in both stocks and bonds is perfectly reasonable. The fund will do the rebalancing for you. When you take money out, it's going to effectively come out. You're just going to sell shares and they're going to send you money. But from a stock bond allocation, it's just going to pull money out in the proportion of stocks and bonds that happens to be in that fund. And her example was 50-50. So if you're not looking to change your asset allocation during retirement, these funds are perfect, I think. And I own, in fact, a retirement income target date fund in my one of my retirement accounts, and I think it's perfectly reasonable. On the other hand, if you want to change your asset allocation, then these probably aren't going to work. And so one example of changing your asset allocation in retirement is the bucket strategy. So that's a strategy where you put a couple years worth of expenses in cash, keep 5 to 7 years of expenses in bonds, and then maybe everything else in stocks. It's not a particular strategy I'm fond of, but it's very popular. And the theory behind it is if stocks are down, you'll leave your stock bucket alone and you'll spend down your cash bucket. And then if need be, if we're in a really bad market, you'll start spending down your bond bucket, again, leaving stocks alone. So what's really happening there is you're suspending rebalancing. You're just going to say in a down market, I'm not going to rebalance at all, because normally what you would do if stocks are down is you'd actually sell some of your fixed income to rebalance back into stocks and buy them when they're down. So the bucket strategy doesn't actually prevent you from otherwise selling stocks. You wouldn't sell stocks if you just rebalanced. What it effectively does is suspend rebalancing and prevents you from buying more stocks. Again, if that's your approach, though, you need the flexibility to be able to just spend your cash and just spend your bonds. And a target date fund or some sort of balanced fund that invests in stocks and bonds won't allow you to do that. It doesn't mean that one of those funds can't be a piece of your overall portfolio, but it certainly couldn't be the majority or all of your portfolio if you want to follow that kind of strategy. Again, I'm not a particular fan of the bucket strategy, so it doesn't affect me. I'm perfectly fine with these kinds of funds because I'm not looking to change my asset allocation, from quarter to quarter or year to year. So that's my take on that question. All right, number 3, does the IRS treat the withdrawal of dividends as taking out earnings or contributions from a Roth IRA? And let me sort of put this question into some context. The viewer had said that what they do is when their investments pay dividends, they have them automatically deposited into a cash account. Comes out of the Roth IRA, goes into a cash account, and they spend the money. And it got them to thinking, well, is that contributions or is that earnings? And why does that matter in a Roth IRA? So it may not matter depending on your age and circumstances. If you're already 59 and a half, you've held your Roth IRA for at least 5 years, you've met all of the rules for tax-free withdrawals, this question might not matter to you. But if you haven't met all of those rules, it could make a big, big difference, because we can always take out our contributions to a Roth IRA, penalty and tax-free at any time. we've already paid our taxes on that money before we made the contribution. So not a problem. But if we take out earnings without satisfying all of the rules, we could end up with penalties, even taxes. So it's a big deal. But here's the takeaway, and I'll preface it with this. I'm not a tax expert. So, if you want tax advice, seek it from a professional. This is my best understanding. But the IRS doesn't even think about dividends from, say, a stock index fund, as an example, versus an increase in the value of the shares of your investment. The IRS doesn't get into those details. All it cares about is it a contribution that you made that you're pulling out, or is it earnings from the contributions you've made? There can also be conversion money in a Roth IRA. We'll ignore that for purposes of this question. And here's how the IRS calculates that. First of all, it treats all of your Roth IRAs as a single account. So it doesn't matter if you have, 3 Roth IRAs, 10, doesn't matter which one you pull from. They view it as all one big bucket of money. And then they say, okay, how much have you contributed over the years? Let's just say you've contributed $100,000 over some number of years. And they say, okay, the first $100,000 that comes out is contributions. It doesn't matter if a particular dollar that you pulled out was a dollar that a stock index fund paid in the form of a dividend, right? It doesn't matter. The IRS isn't looking at that level of detail. If those first $100,000 that come out, they're going to view those as withdrawing your contributions, which is good for us, right? Because again, you can pull out your contributions anytime for any reason, tax and penalty free. It's only once you've pulled out all of your contributions that you start to pull out earnings from an IRS perspective. And again, in that context, they don't care if it's a dividend, if it's an increase in the value of the shares. It's all fungible money. That's not how they're looking at it from a tax perspective. So yeah, it's contribution first, regardless of how you attribute that $1, right? And also regardless of which particular Roth IRA you're pulling it from. And then only after you've withdrawn all your contributions are you deemed to have started to take out earnings. So hopefully that helps. Again, that's my understanding. Always verify before you make any big decisions. All right. Question 4. Is an 80% chance of success in retirement reasonable? And this was, I think, a great question. And the heart of it is down here. They say, this is where I like the idea of an 80% success withdrawal strategy. Simply put all of your investments in Bolden or similar retirement software, and then adjust your withdrawal amount so that the Monte Carlo simulation predicts that you have an 80% or better chance of success. That's it. As your funds start to drop or increase, you simply adjust your amount of withdrawal to keep the level of success at 80% or better. Simple. What do you think? So this idea of a chance, they call them chance of success guardrails. There's all kinds of articles on this. I'll just show you a couple and I'll leave links below the video, but here's one from Kitces, using probability of success driven guardrails to manage safe retirement spending. This was one on a somewhat different issue, but related to what's called Guyton-Klinger guardrails. Morningstar has an article on this very topic that I was looking at, also from Kitces. There's several. I'll leave links to them below the video, but let's take a look at Bolden and see how this might work. So this is a demo account from Bolden. This is the retirement planning software that I use. I think it's great. I'll leave a link to it below the video. And again, this is all hypothetical data. You can see we have a 93% chance of success. Now, I could go in here and increase the spending until we got to somewhere near 80%, right? I'm just going to make up a number. I'll just say 6,700. Not quite sure what that will do. Let's see. 73. So we could just adjust that, right? We could come back in and say, make it 6,300. That'll probably get us, make it 6,400. Might get us close enough. And now we're at 78. So we could come up with a plan where we zero in the chance of success and it's 80%. And as the viewer mentioned, we would update our accounts as the values change. Here they are. We can update balances. So, we spend some money out of the checking account or out of a traditional IRA or wherever. We update the balances. There's market returns, and the market's up, the market's down. We could update the balances, right? And then we could then check the chance of success. And if it drops, in his example, below 80%, we could come in and at that point, presumably decrease our spending so that we got this chance of success back up to 80%. That's sort of the idea behind it. And as a general rule, I really like this approach. But I want to sort of just highlight a couple things to think about as you maybe consider this for your retirement plan. The first is not all chances of success are created equal. So you could imagine two different plans, even with the same amount of money in the bank, same amount of expenses, same life expectancy, everything's identical, and they both have 78% chance of success. And one plan could be what I would call very resilient, and this other plan, again, all the same numbers, could be very fragile. Why? Well, let's go to the expense number. One plan could have, both of them have $6,400 a month in expenses. Again, we'll assume the same Social Security, everything. But one person could say, yeah, that's what I can spend now and I'm enjoying life. But, I could really cut back if I wanted to. If I had to go down to $4,000 a month, we'd be okay. I might not travel as much. I might not eat out as much, might not be happy about it, but I'm good. Another person could say, oh no, Rob, I need every last dollar. If I don't get $6,400, I don't pay the utilities. I mean, it's a big, big problem, right? So that's the first thing to think about. When we go back to this chance of success, you really want to think about how resilient and fragile your underlying assumptions are, particularly as it relates to spending. How much flexibility do you have in that number? If I don't have much flexibility, I'm probably going to want a higher chance of success. On the other hand, if I have a lot of flexibility, I could really reduce my spending. I might be okay with a lower chance of success. And the same is true with our accounts. Right now, for most of these accounts, I'm assuming what's called a moderately aggressive 8.8%. This is part of the changes to Bolden recently, where they're giving us more options with how we can set rates of return. And one could debate whether that's conservative or aggressive. Part of it, of course, would depend on how you're investing your money, in this case, in a 401k account. But if you're using an aggressive number and really low inflation, those are pretty aggressive assumptions. And I like to stress test my portfolio. So it doesn't necessarily mean lowering the rate of return for the entire duration of the plan. What I might do is come in here and say, well, I think maybe, let's assume for the first 10 years, stocks don't do as well. And you could even go lower than that. I could go to custom and I could say, what if we're only going to get 2%? Markets are kind of overvalued a bit. And so maybe the next decade, it's not going to look so good. But then 10 years from now, and I'm just going to throw in a number here, we'll put it somewhere in 35. And we'll get back to what I think is more of a long-term average, given how I'm investing in my account. So I can model those sorts of changes in rate assumptions, for example, and then look and see how that influences my plan. And it dropped it to 65%. Again, I would look at all of the other assumptions as well, such as Social Security and pensions if you have it, and really every aspect of the plan. But you can get to a point where you might have the same chance of success, or maybe even you're willing to tolerate a somewhat lower chance of success. But your underlying assumptions are perhaps more conservative, or in some way you feel that the plan itself is just more resilient because you sort of accounted for a lot of the potential risks. Now, having said all of that, a couple other things to think about. I don't know that you need to update your plan, every day the market closes and then make a change to how you're spending your money. I just don't think that's very realistic. Frankly, I think you could get away with just looking at it once a year, where once a year you update all your numbers, you look at your chance of success, and you assess, okay, am I still on track? Do I need to make any changes to my spending or not? And here, the other suggestion, the final suggestion I'll make is, I'm not sure I would settle on a single percent. That just seems to me, it's like, putting a decimal point where you just don't have that level of precision, right? And so I kind of probably think about it more in terms of ranges. So if I'm comfortable with 80%, I might say, okay, I'm not going to make a change to my spending unless it drops below, let's say, 75%, or maybe even 70%. Or, I'm not going to increase my spending until it gets up to 85 or 90%. In other words, I might think of these chance of success guardrails in terms of a range rather than a single point number. So I think with those sort of thoughts, you might be able to come up with, I think, a really effective way to think about your spending in retirement and assessing just how comfortable you are with your plan. So that's my take on it. But by the way, I think it's an excellent approach. It's part science and part art. It's not just all math and calculators, because again, we're making a lot of assumptions within the plan, whether you use Bolden or something else, to arrive at that answer. The other thing I'll mention just briefly before we move away is that Bolden uses Monte Carlo simulations, which is part of a sort of an industry standard approach. But I also think it's worth thinking about your chance of success based on historical data. That's something that Bolden at the moment doesn't allow, but you can get a rough idea from FI Calc, right? Because you can put in your duration. This isn't a retirement planner, so you can't input all your data and everything like you can in Bolden, but you can put in your overall portfolio amount. You could set a rough asset allocation, and then you could run chance of success based on historical data, and you can even look at year by year which years, for in this case a 30-year retirement would have succeeded, meaning you wouldn't have run out of money, versus when you would have failed. I think that's a good way to look at your chance of success beyond just Monte Carlo simulation. If you use Projection Lab, by the way, which is another tool I like quite a lot, and I'll leave a link to it below the video, you can run both Monte Carlo simulations and do a historical analysis within that one tool. If you use Bolden, I would recommend maybe every now and again running your numbers at a high level through something like FI Calc as well. Okay. Last question. How much should you allocate to international stocks? This was the question from the viewer. I'm happy, healthy, and comfortable 67-year-old. My portfolio allocation is 65% stocks and 35% bonds, and I feel good about that. My allocation of stocks between U.S. and international is not principled. I accidentally ended up with the allocation of my stocks, and I don't feel good about it. How should I think about selecting a reasonable allocation for my stocks between U.S. and international that is principled and that I do feel good about? Well, I don't know if I can answer that really for you, but I can tell you generally how I think about it. The first is, it's kind of like doing retirement planning. So there's art and science to it. I don't think there's a single number that you could call principled that says, all right, this is how much you should have in U.S. stocks and here's how much you should have in international. Maybe the closest thing you could get to that idea is to simply try to mirror the market. What is the overall global allocation of capital to stocks? And to do that, we could go here. I'll just show you an example. We're back to Morningstar. This is one of the articles I'm going to link to below the video for you, but I'll move away from it for just a second. Actually, we'll open it up as a new tab. This is Vanguard's Total World Stock ETF. It's a global fund that invests in both U.S. And international stocks based on market cap. And if we go to the portfolio, we can see here it's roughly 61% U.S. equities and 37% non-U.S. equities, has a bit in cash. But that's roughly the allocation based on the values of publicly traded companies throughout the world. It wasn't always this way. We go back to the 80s and Japanese companies really dominated the market. Today, of course, U.S. companies do. In fact, if we go down here to the portfolio where we look at actual companies, the top 10 companies are all U.S. based. And in fact, there's only one in the top 20, Taiwan Semiconductor, that's outside the U.S. So it's definitely dominated by U.S. companies. But still, for every $100 you invest in this fund, about 37 bucks will go into international companies. Now, I will tell you that my portfolio does not match this. I'm probably about 20% international, and I'm not in a particular hurry to change that. And you say, well, how did you arrive at that? Honestly, it just felt right. It felt like enough. If I'm being totally honest, there wasn't some mathematical formula. I didn't open up an Excel spreadsheet. It just felt like enough allocation away from U.S. markets, along with the fact that, of course, the largest U.S. companies do business around the world. And it does raise the question, how important is it where a company is headquartered? I think it has some importance. One could argue that at least over the last 100 years, it's become less important, although now that we're in a mode of maybe tariffs, maybe not tariffs, I don't know. Does it become more important? I just got to a point where I was comfortable with about 20%. Now, that doesn't, one might argue, well, Rob, that doesn't seem very principled. Well, maybe not. But maybe what matters more, and maybe a way to truly understand what a principled amount of any allocation to any asset class is one that you can live with and stick to no matter what's going on in the markets. And if that's how we measure it, I can tell you 20%'s worked quite well for me because that's been my allocation for a very, very long time. So you could just mirror the market. I would put you at roughly 37 to 40, or well, we'll call it 35 to 40% international. I think that's probably principled because it's simply matching the market. If it's something different than that, you might have a reason for it. And again, then the question would be, can you stick to it? So that's my best answer to a good question. How do you figure out how much international exposure to have in your portfolio? Hopefully that proves helpful to you. Well, there you go. Those are the 5 questions. Again, I will leave links to the articles, particularly on chance of success guardrails that you can check out. I'll leave links to Bolden and Projection Lab. And of course, if you have any questions, leave them in the comments below. I'll be happy to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.